trade-off theory is slightly different, and trade-off theory says that we expect managers to prioritize the next source of capital by trading it off the costs and the benefits of that source of capital. And so this is a point-in-time theory. It doesn't establish a hierarchy of preferable capital right off the base. It says that at any point in time, one source of capital might be preferable to the next. So a firm that has lots of debt, even though debt is relatively cheaper, might find that on the margin, at the next time they want to raise capital, equity would be cheaper than debt at that point in time. Or, for instance, a firm that has never raised debt, but has only ever issued equity and used their savings account, might find debt to be the cheapest source of financing, even if they have a lot of money in their savings account. And you can see this kind of thing happen. It just recently happened with Apple. Apple has like $100 billion in their savings account. They had never issued debt, and 5 years ago or so, it was so cheap for them to take out a loan. The interest was so low that instead of spending them cash they already had, they issued debt instead. Okay, so it doesn't seem like firms, it seems like pecking order and trade-off theory are applicable in different times and in different ways. But there does, just because it doesn't look like there is some optimum way to raise capital, it doesn't mean that there isn't some hierarchy of capital that we can use to guide our decisions. Okay? And the last thing that I really want to talk about, and that we should really, that has huge impact on financial decision making, is something called leverage. Now, leverage is basically just the use of debt. Right? So in finance and economics, leverage just means debt. A firm that's using leverage is using debt as a lever to fund investments that they couldn't normally afford. Right? So here, leverage has the same interpretation as it would in, say, physics. You use a lever to move a weight that is much heavier than you could otherwise lift. And the power of the lever comes from the fact that you can be far away from the leverage point with your lever, and the farther away, you can move heavier weights. Right? There's the famous saying that with enough leverage and an unmovable point, you could move the world. And that's probably true. Not possible, but true. And leverage works the same way in finance and economics. Right? In finance, leverage is the ability of debt to allow you to take investments that wouldn't be available to you. Right? So for instance, we talked about from a personal perspective, if let's say I wanted to buy a new laptop, I might be able to use my savings account to buy the laptop. But if I wanted to buy a new house, I certainly don't have the available money in my savings account to buy a house. So I want to buy something that I couldn't already afford, make an investment that I couldn't already do. And the way I do that is I use debt as leverage. I go to a bank and I borrow the money, and I use that money to then buy my house. This is how leverage works, because otherwise I couldn't come up with that money on my own. Now, firms have a much greater ability to use leverage and debt than individuals. Right? A firm can borrow a significant amount of money and put it to use. And ideally, they're borrowing that money to make investments in projects, to pay new employees, to run the business in a more efficient way, or just take investments that they wouldn't already be able to afford. Now, this is a really, really valuable tool. Lots of people are very scared of leverage and debt, and for good reason, because debt comes with a significant cost. If you can't pay the interest payments, if you can't make your loan payments, you lose access to the things that you purchased with the debt, right? It's called bankruptcy and foreclosure. If I don't pay my house payment, the bank just comes and takes my house away because they were the ones who loaned me the money. So the use of leverage contrasts with the risk of leverage, which is that as soon as you use leverage to make new investments and to fund investments that you couldn't have undertaken without it, you now open yourself up to a loss of control if for some reason you have a bad spell, right? So for instance, I'm going to use the pandemic a lot as examples, but in the situation where you're a business that just took out a loan, say last year, to open up a second location, and then the pandemic hit, and you had to close down your restaurant for 3 months, all of a sudden you're in significant trouble because you didn't open this with your own money. You don't own the buildings outright. The bank does, and you owe the bank. And so if you don't make your mortgage payments, you don't make your loan payments, the bank comes and claims it, and you lose everything else that you've tried to invest in that business. Right? So the use of leverage is a really powerful tool. The risk of leverage is what hopefully causes financial management teams and individuals to be cautious about the use of leverage. Right? Now, the last thing that we care about here and this is mostly a difference from the balance sheet, and this is mostly a difference between the accounting balance sheet and what a financial management team cares about from the balance sheet, is this idea that there's a difference between something called market value and what we call book value. Now, on the balance sheet, according to GAAP rules, GAAP is the generalized accepted accounting principles. So these are the rules that govern the accounting statements in the U.S. According to those rules, items on the balance sheet must be listed at something called historical price. So if I buy a truck for $30,000, I write it as an asset on my balance sheet for $30,000. That's the book value of this asset. It's written on my books. Now, according to certain rules, I can depreciate those assets, I can change the value of those assets, but typically, unless something else happens, unless depreciation occurs, the assets are listed at their historical price until I rid myself of them or depreciate them completely. Right? And this can be particularly important, say, a couple years down the line when I may have a truck that I just bought. Let's say I buy a truck tomorrow. Well, 5 years from now, I still own that truck, and it might still have some value on my balance sheet. It might have a book value of, let's say I bought the truck for $30,000. It might have a book value still of $15,000 in 5 years, and that means that. And that might be different than the actual value of the truck if I tried to sell it. That actual value, if I tried to sell it, is what's called the market value. Now, this distinction is important and it can be a lot bigger than, say, the difference between, the value of a truck and the actual value of the truck and the book value. So, for instance, when you buy land, you book that land at historical price. And we could have very old firms that have very old land purchases that are still listed at historical price. So you can think about an example of, say, the railroad companies in the US. When they built the transcontinental railroads back in the 1800s, they needed to buy an enormous amount of land. So much land that, of course, nobody could afford it. And basically what happened was the US government gave them great deals, sold them strips of land across the US to build their railroads on at just rock bottom prices, a couple $100,000 to buy a strip of land that cuts the U.S. in half. Right? Here's my map. Right? A strip of land that cuts the U.S. in half to build a transcontinental railroad, and they sold it to them for maybe $250,000. Well, that was 200 years ago almost, and if they still had it listed at historical price, and under some assumptions that they could certainly have it listed as historical price if it's never been resold or reevaluated. And if we looked at that strip of land now, there's no way that we would say that it's still worth $250,000. Right? A strip of land that cuts the U.S. in half is probably worth $250 million or more. And the difference between the book value, what we bought it for, and the market value, what we could sell it for, might be extremely, extremely significant. And if we're the financial team and we're trying to assess the value of the firm or the value of the investment, or maybe we're looking at selling the company, right? Warren Buffett just bought a railroad about 6 years ago. You think that the financial team of the railroad, when they were selling it to Warren Buffett, wants to sell it at book value or market value, right? We don't want to sell it for $250,000. We want to sell it for what it's worth now, which might be, a couple $100 million or more. So the financial team needs to adjust the values on the balance sheet to be market values rather than book values. And this is a really important thing because valuing the firm and its assets is an important part of valuing the investments that the firm has and valuing the firm itself.